Hey everyone, you know that sinking feeling when the so-called pros declare the good times are done? They kept yelling, the bull run's busted. Gold topping $5,500 is just hype ready to burst. Bail out now, they insisted, or regret it big time. And then yesterday's wild $485 gold plunge in barely half an hour? They screamed it's all over.
Totally, like full-on freak-out territory, huh? As if, do I dump it all and run for cover? But hold up, while folks are hypnotized by those plunging charts, what if the real bombshell slipped right by, the shady clues pointing to a total setup?
You got it. We've been flagging the brewing war tensions, that Iran hotspot like a fuse about to blow, the dollar's in a nosedive, and yeah, the top brass is all for keeping it soft. But yesterday, no fireworks, no world drama, just a crafty timed sell-off. It all sparked from big tech like Microsoft cratering, igniting a frenzy of margin calls that hammered gold like nobody's business.
Picture those hedge fund cowboys fumbling their bets and yelling, "Yee-haw!" on the way down. If you gripped your silver tight as it tanked to the floor without a twitch, you're straight up legendary, the type that has the behind-the-scenes schemers losing sleep.
Absolutely. Smash that subscribe button now. Light up those notifications, because we're peeling back the layers on the culprits, the motives, the tactics, and why this stunt just exploded in their faces. We're exposing the ultimate market heist.
And believe me, it's spicier than a blockbuster Wall Street thriller. Let's roll into the blow-by-blow timeline, because none of this was random chance.
Right, set the scene. 9:30 a.m. Eastern, markets kick off. Microsoft dives 7% right away. By the end, it's down 12%. Roughest day since the pandemic mess. That's a $357 billion value wipeout, second biggest ever in a single go.
Whoa, like evaporating a mega economy's worth in hours. Now, switch to gold. From teasing $5,594 highs earlier, it tanks $485 in about 30 minutes from 9:45 to 10:30. Bottoms out around $5,109. Silver? Identical chaos, from over $121 peak to $107 nadir.
But get this, by close, gold fights back to around $5,330, just a slight dip overall. Silver rebounds to $115. If gold's all about real threats like conflicts or rising prices, why did it sync up so eerily with Microsoft's flop?
Spot-on query. Smells like a plot, doesn't it? Turns out it's textbook cross-market mayhem. Those juiced-up tech funds needed quick cash, so they treated their gold holdings like a panic button piggy bank.
So we've got this eerie sync-up between tech giants tanking and precious metals going haywire. But why the brutal speed? A $485 drop in gold over just 30 minutes isn't your everyday sell-off. That's a total liquidity blackout, folks.
Yeah, like the market just hit an invisible wall and plummeted. Ever wonder if Wall Street's more like a high-stakes casino where the house always rigs the game? Spill the beans on how this heist went down.
Spot on with the casino vibe. Experts from places like Saxo Bank nailed it. Volatility feeds itself like a monster. As swings amp up, liquidity evaporates. Banks and market makers bail because they can't handle the heat, especially with that futures physical basis squeezing tight.
Ha! So the big players just ghost the party when things get too wild. Translate that for us mere mortals. What happens when the pros pull their bids?
Exactly. They vanish like smoke. Under Basel III rules, these banks are capped on risk. So when volatility blasts past that RSI 90 overbought zone, they widen those bid-ask spreads from pennies to full dollars per ounce. Order books, they go bone dry. Those chunky 100-lot bids that usually cushion the fall, poof, gone.
Oof, sounds like a recipe for disaster. Then what? Stops triggering like dominoes?
You bet. Sell orders cascade at ever lower prices with zero buyers stepping up. Boom, a massive air pocket forms between 5,500 and 5,100, right where the crash exploded. Brokers confirm, banks aren't endless vaults. They've slashed risk, volumes tanked. They let it plunge on purpose, flushing out the weak hands, triggering your stops so they can scoop up cheap at 5,109.
Sneaky. But wait, there's more layers to this fury, right? Like those exchange hikes making it pricier to stay long?
Absolutely furious making. In the lead-up, global futures exchanges cranked margins sky high amid insane volatility. Timeline? CME tweaked rules Jan 13, jacked silver to 11% Jan 28. Shanghai panicked with 3 hikes in 10 days, hitting 20% now. They knew longs were maxed out, made holding expensive exactly when leverage was peaking.
Classic trap. Walk us through that vicious cycle. Feels like a death spiral designed to shake everyone out.
Step 1. Exchanges hike margins, forcing leveraged longs to pony up more collateral or get liquidated. Step 2. Margin calls hit, sparking forced sells, prices nosedive. Step 3. Drops trigger stops, more selling floods in.
And then?
Step 4. Market makers bail, liquidity vanishes into thin air. Step 5. Price gaps widen, acceleration ramps, loop back to step 1, rinse and repeat. Even industrial silver hedgers got slammed with calls on futures, turning specs and commercials into simultaneous forced sellers. Toxic combo, rare as it gets.
Whoa, so the crime boils down to...
Exchanges rigged the game with margins to spark liquidations. Microsoft's 12% flop, worst since 2020, ignited hedge fund calls. They dumped gold and silver like hot potatoes for quick cash. Makers amplified by ghosting bids, stops snowballed. Retail woke to 5109 thinking doomsday, while silver cratered 31% to $78, its ugliest day since 1980.
Brutal. But here's the twist. The trap snapped shut on them, didn't it? With that V-shaped rebound proving the dip was just noise?
Beautiful irony. Gold's panic low at 5109, but by Friday morning, it's clawing around 48.90 after more dips, still down big, but showing bargain hunters absorb the wave. Silver from $78 low to 85-ish, up 9% recovery, but miles from $121 peak.
Man, that crime scene we just laid out was brutal. Exchanges hiking margins, hedge funds dumping like hot potatoes after Microsoft's epic flop, market makers vanishing into thin air, retail folks staring at gold hitting $5,109 and silver cratering 31% to the $78 zone, thinking the whole bull run just imploded.
Yeah, total heart-stopper, like watching your favorite team blow a huge lead in the final quarter. But here's the plot twist that makes this whole thing epic. The trap they set, it totally backfired on them.
Big time. Gold's panic low was $5,109 on that wild day, but even after more selling pressure dragged it down to around $4,890 this morning, bargain hunters jumped in hard. Physical buyers in India and China didn't blink. They saw the dip and loaded up.
Love that. Quote from the reports. After the massive drop, bargain activity surged, soaking up the entire liquidation wave. Who were these heroes? Retail and institutional folks paying premiums over spot in China, flipped from discount to plus $3 quick. India, bar and coin demand exploded 70% year over year in early 2026.
And get this, even on the crash day, North American gold ETFs saw inflows, not outflows. We're talking positive flows while the price tanked $334 million or more in one session. That's the smoking gun that this was technical noise, not a fundamental collapse.
Exactly. Institutions know the difference between short-term panic and long-term value. They spotted gold at those lows with the dollar still weak, war jitters brewing, and thought, gift. Physical demand from Asia absorbed everything the hedge funds puked out.
So the V-shape, it happened, but volatility kept pushing lower short-term. Yet the recovery speed shows resilience. Silver clawing back some from 78 to around 85.99. Distance from peaks is big, but the buyers are still hungry.
And why wouldn't they be? The core thesis is rock solid. Nothing changed on that crazy day. Let's run down the pillars holding this bull up.
Pillar 1, central banks averaging massive buys. Goldman estimates 60 tons a month, diversifying away from the dollar. Pillar 2, ETF inflows insane. North America alone pulled in $51 billion for 2025, record stuff, and Asia adding billions in January. Global ETFs hit $89 billion inflows last year.
Pillar 3, dollar weakness on full display. DXY at 4-year lows, Trump openly cheering a softer buck. Fed rates still leaving real yields negative. Pillar 4, geopolitics. Iran tensions boiling, with strike options on the table and U.S. military buildup. No de-escalation there.
Pillar 5, Fiscal nightmares, U.S. debt ballooning, Japan's yield spiking, shutdown partial kicking in right now over the weekend. Funding lapsed for key agencies like DHS, DOD, HHS. Senate passed a deal, but House votes Monday. History shows shutdowns juice safe havens like gold.
So yesterday's violence? Just mechanical selling from over-leveraged tech plays, not a repudiation of gold's safe haven crown. Analysts like Citi eyeing $150 silver soon. Deutsche projecting gold over $6,000 in 2026 on dollar decline. Standard Chartered called it a mid-air refuel. Corrections clear froth for the real climb.
Bottom line, the manipulators engineered a scare, but the fundamentals didn't budge. Physical buyers stepped up, ETFs kept flowing in, and now with shutdown drama unfolding and Iran risks simmering, the setup for a rebound is juicy.
Did you freeze or did you pounce? Drop in the comments. Type I bought if you added on the dip around $5,100 or lower. Type I held if you diamond-handed through the storm. Let those Wall Street schemers know their tricks didn't shake us.
All right, with those unbreakable fundamentals locked in, central banks hoarding, ETFs pouring in, dollar wilting, geo fireworks ready to pop, and debt mountains growing, that crash was just a blip. But what's next? Let's game out the weekend wildcards and how to play them.
Oh, the suspense, like waiting for the next episode in this Wall Street thriller. We've got two big catalysts brewing. That partial government shutdown that just kicked off at midnight, and the Iran powder keg that's one spark from exploding.
Spot on. Historical data screams shutdowns pump precious metals. Goldman even bumped their gold forecast to $5,400, citing fiscal chaos. And Iran? Trump's armada is sailing in, bigger than the Venezuela fleet, with strike options on the table to shake up protests. Time's running out, he says. Could hit in days.
Sounds like DC's soap opera meets Middle East action flick. So bearish scenario first. Low odds, but what if?
Bearish, say 20% chance. Shutdown gets patched quick with House voting Monday. Dollar bounces a bit. More tech tremors trigger another liquidation wave. Gold might consolidate in the $4,800 to $5,000 zone, testing that key support. Silver hangs around $80, $90. If it dips more, that's your golden, pun intended, buy signal.
But the bullish case, that's where the money's at, right?
Bullish, consensus 80%. Shutdown drags on past Monday, sparking safe haven frenzy. Iran tensions flare, maybe a strike window cracks open. Gold retests $5,600 highs by next week. Silver blasts toward $150 like Citi predicts. Futures backwardation kicks in, VIX spikes over 16, and stocks rotate to hard assets. RSI's cooled from overbought 90s to mid-70s. Perfect setup.
Love the odds. Now the playbook. How do we win this game?
If you're a holder, treat this noise like a bad storm. Hold tight, add on dips like the current $4,890 gold level. Scale in, don't all in. Your 13% monthly gain, still intact despite the volatility.
For the sideline crew watching from the bench?
Sideline buyers, this $4,800 to $4,900 range screams value after the overshoot to $5,600. Physical premiums popping in China and India confirm it. They're stockpiling at discounts.
And traders chasing the action?
Traders, eye that $4,800 support and $5,500 resistance. A close above $5,000 today sets up a Monday gap higher if shutdown headlines escalate or Iran news drops. Limit orders ready, don't chase.
Solid advice. But remember, that crash was a scare tactic, straight out of the manipulator's playbook. Margins jacked, Microsoft cover story, makers ghosting. They thought you'd fold like a cheap suit.
But nope, you held. Global buyers lined up in Shanghai and Mumbai for bars. ETFs slurped $334 million on the worst day. Institutions hit buy at 5109. The trap busted. They got schooled.
And now, with shutdown partial underway, Iran risks boiling, dollar crumbling, Fed stuck, oil climbing, gold's dip to $4,890 is a gift. The recovery's brewing, fundamentals firing on all cylinders.
Are you geared up? Smash subscribe now. Flip on notifications. If shutdown drags or Iran ignites, we'll break it live Monday with potential gap to $5,800. You gotta be here.
Drop comments below. I bought the dip at $4,890. I held strong. Be real. This community's about truth. The more we share, the weaker those schemers get. The heist failed. Bulls alive. See you Monday.